Hello everyone, this is ACCA Amit Kumar. I'm going to share with you the concept of other comprehensive income. So before I start the session, I would like to inform that Unacademy is beginning a warm-up session for November 21 with the top educators of Unacademy who are teaching CA final. So for CA inter aspirants, there is a batch beginning on 28th of December. So you can subscribe it today immediately, and the top educators like CA, CS, Anshul Agarwal, Alina, Shrey Rathi, and CA Vikram Biani. So all the top educators who are providing their services for CA inter aspirants are coming together for this warm-up session. So would request you to subscribe for it and gain insights from their learnings which they've gained working hard over years. So all the best wishes for the ones who subscribe for this course. Let's begin with the concept of OCI. So I'm going to discuss with you the concept of other comprehensive income, which is covered by Ind AS 1, presentation of financial statements. So Ind AS 1 is the standard for dealing with presentation of financial statements, in which we cover all the financials, balance sheet, income statement, statement of cash flows, statement of changes in equity, and notes to accounts. So among the components of income statement, so is the concept of income statement is divided into two parts: profit or loss account and other comprehensive income. So in IFRS, this was allowed in two statements. Like there is an option in IFRS that we can present profit or loss separately, and we can present the components of other comprehensive income separately. There's a choice that we can present it in a single statement, that we begin the statement with profit or loss and then profit for the year. We also present the items of other comprehensive income in a single statement, and we use single statement approach. So in India, in Ind AS, we have opted for single statement approach where we'll be presenting other comprehensive income and profit or loss as part of the single statement. So I'm going to discuss with you the items of other comprehensive income. At the global level, this is known as a statement of profit or loss or other comprehensive income. If someone has been following IFRS earlier, has seen it, there was confusion in the heading of this statement. It was, if an entity is using two statements, they were naming it differently. If they are presenting a single statement, they were calling it statement of comprehensive income, which was covering both. So that confusion is eliminated at global level by naming it as statement of profit or loss and other comprehensive income if someone is presenting it in a single statement. So we'll be presenting it in a single statement, the items of other comprehensive income. So what exactly is OCI all about? Now, P&L of any entity is indirectly the performance of that business. It's about the faith shown in the business, in the stewards of the business who are managing the affairs of the business. So we try to judge their performance on what decisions they have taken throughout the year, how much they have contributed to the top line revenue, what expenses they've incurred to generate this revenue, and how they manage the affairs of the business. So P&L is indirectly giving us insights on their activities, which they begin on the first day of the financial year and which ends on the reporting date. Throughout the year, what activities they've done, and have they contributed to the growth of the entity, or they have resulted in losses. Now there are certain items which the management says that it is not in their control. They are not able to directly influence the decisions of some of the line items which are presented as part of the balance sheet, which is presented as part of the income statement. So the stewards of business kind of sought a relief that we should not be judged on the basis of these line items. So in other words, we can say that these are unrealized gains and loss which are not realized yet, but since we have booked them as part of our balance sheet, we need to present them. If we present them as part of P&L, then the stewards of business get affected because of it. They are unnecessarily given credit for the gains which they have not resulted into, or their actions or their decisions have not resulted into those gains, and they are also not blamed for the losses. So those items are classified into two categories. One is items which can be reclassified to P&L, and items which can never be reclassified to P&L. Items which can never be reclassified to P&L. What it is trying to say that though we have presented these items as part of other comprehensive income, we have presented them as part of other comprehensive income, but still there are certain areas which can be influenced by the decisions of the management tomorrow. So we divide it further. We are trying to make it easier for the users of financial statements so that they can understand it better. So it's about the understandability of financial statements, that we are trying to help them understand financial statements in a better manner so that they can have good faith into the results. So we tell them that the items which can be reclassified to P&L means tomorrow if a decision is taken by the management which directly or indirectly influences this gain or loss, either on settlement, either on disposal, then it may be routed through P&L. And if it is being influenced by the decision, routing through P&L means we are trying to give credit for the gains resulted by them, and we will also be holding them responsible for any losses they have incurred because of settling them or disposing those items. So when I say they are classified into two categories, one, items which can be reclassified to P&L, items which can never be reclassified to P&L. So first we'll have a look at the items which can never be reclassified to P&L. Among them, there is revaluation surplus, there is unrecognized actuarial gain or loss, unrecognized actuarial gain or loss, there is financial asset in terms of equity instruments designated at fair value through OCI. So even on settlement, they are never reclassified to P&L. What is the reason behind it? Why they are never reclassified? So if I talk about revaluation surplus, suppose there is a land which was purchased for 5,000, and after a certain period the entity decided, suppose after a gap of 30 years the entity decided, or we can say that while we were moving to Ind AS, we decided that we will be revaluing this land for 1 crore. Now imagine if I take the difference to P&L. If I record the entire difference to P&L, profit or loss, I think we'll be definitely eligible for a call from the Finance Minister or Prime Minister of India that please guide us how you did this. Like, you suddenly became profitable, you were loss making till date, but suddenly because of recording an asset in your books at a higher value, you could become profitable and your profits are rocket high within a day. Do you think we should route it through P&L? And if I take it to P&L, even the tax authorities will definitely would like to take a look at how we have gained this profit, they are also expecting on this capital gain, they are also expecting some money. They have come up with their own set of rules to charge capital gains tax on us, but we didn't have any cash like to offer to them. So they notice that it is unrealized gain yet and it's not realized yet. Instead of it, if we would have sold this land, then we can say that the 5,000 worth of land was sold for 1 crore. We have realized a gain of 99,95,000. We are cash rich now, and if we are cash rich, there is no harm paying to the government as well to support the infrastructure in the form of taxes. But we don't have any cash with us. And even if we route it through P&L, that will also not be a good idea to inflate our profits immediately. So what do you think? What shall be done? So the easy way out is that the revaluation surplus is always presented as part of OCI. The other option given is that only on disposal or derecognition of asset it is reclassified directly to equity. So when we revalue an asset, if it results in a loss, then being conservative, we book the loss immediately to P&L. But if we are expecting a growth in the value of an asset on revaluation, that growth we are presenting to revaluation surplus. Unless we have suffered a loss previously on the same asset, if we suffered a loss previously which we have charged relating to this asset in P&L, and in future if it reverses, then our duty is to first reverse the loss which you have charged to P&L, because P&L is unnecessarily hit, and if we don't reverse it and directly book it as part of OCI, then P&L will definitely would like to recover back the money at least which you have charged relating to this asset. And if you are gaining today and if you expect a growth in terms of value, please pay back my money and reverse the loss charged to P&L in case of a first time decrease. But if it is increase and we already have a reserve, and then subsequently if there is a fall in the value of an asset, we will not charge that fall in the value of an asset directly to P&L till the time we have a reserve relating to it. So we'll first eliminate the reserve. Any excess, if there is any fall in the value of an asset, we can charge it to P&L. So if we have a reserve, it can be eliminated to zero, but it will not be routed back to P&L. So this is one item which remains. I hope you got it, why we are not presenting it as part of P&L and why we are presenting it as part of other comprehensive income, because this is an unrealized gain. So revaluation surplus is one item which is presented as part of OCI. Second is unrecognized actuarial gain or loss. So under Ind AS 19 employee benefits, under Ind AS 19 employee benefits, among post-employment benefits, there are two types of benefits. One is defined contribution plans and one is defined benefit plans. Defined contribution plans are pretty straightforward, that whatever we intend to contribute to a fund which the employee is eligible to receive post-employment, the employer doesn't make up for any loss and builds up an asset to meet this obligation. But in case of defined benefit plans, the benefit is defined by the employer, or we can say entity, and will have to make up for the loss if the fund doesn't perform as expected. The example of the defined benefit could be 1% of last known salary for each year of completed service. So when we are accounting for defined benefit plans, we'll be able to account for the liability first time with the help of an actuary who will give us the fair value of the liability which we need to create, and will also contribute to a fund. Now this liability will be increasing with the interest expense over the year. This fund will be increasing with interest income over years, will be contributing to the fund every year, and this liability also increases as the employees complete years of service. The moment an employee completes 1 year of service, they become eligible to receive an amount post employment. Suppose the employee is expected to leave in 2025, but if they have completed 1 year in 2021, for completing a year 2021, they become eligible to receive an amount in 2025. So this is known as current service cost. The amount which we are liable to pay at the end of 5th year, we'll be discounting it to present value and will include it as part of our expenses in P&L today, because we know that the employee has completed 1 year, employee has earned that amount which the employee will be getting post employment, but they earned it today for the services they have provided this year in 2021. So we include the expense related to the income earned by the employee in the year in which they have earned it. We charge it to the year in which they provided their services. So we discount it to present value and include it as part of our current service cost. If there is any change in this defined benefit, if there is any past service cost, we also charge it as part of the P&L, because that's a decision made by the management to bear this additional cost. If there is any benefit paid out of the funds, our liability reduces, our asset reduces. So we are able to account for the transactions between the opening and closing balance. But in spite of this fact, when we demand the fair value of asset and liability from the actuary, it differs from what we recorded. So this difference which we could not record, which remained unrecorded, is known as unrecognized actual gain and loss. That despite the fact being good accountants, being principally sound in the knowledge of accounting, we could not account the difference between the opening balance of planned assets and planned liabilities, the accounting we have done throughout the year, and when we demanded the fair value of planned assets and planned liabilities at the end of the year, there is some difference. This difference is known as unrecognized actual gain or loss. Can we hold the management responsible for this gain, for this loss, or give credit for any gain on unrecognized actual gain or loss? I think it will not make any sense if we give them credit or even if we blame them for any losses. So the best way to present unrecognized actual gain or loss is to present them as part of OCI, and till the time the entity continues, I think the employee benefit plans will also be in existence. So they'll remain as part of OCI, they are never reclassified to P&L. So if you look at what could have been presented, like if I present profit or loss, P&L, if I'm presenting assets, unrecognized actuarial gain or loss, and liability. So when we are presenting them, unrecognized actual gain or loss, liability, there is an opening balance which in first year of existence will be dependent on what the actuary believes to the calculation that what we are liable to pay. Second year it becomes the opening balance. So this is given to us by the actuary. The last year's closing balance becomes the opening balance for this year for fair value of planned assets and fair value of planned liabilities. This is given to us by the actuary. If we have paid out any benefit, benefit paid out. If there is any benefit paid out which will reduce the assets, which will reduce the liabilities. Interest expense will be a debit to P&L and will be a credit to liability. The service cost for the year, if there is current service cost or past service cost, that will be debited to P&L and credited to liability. So this is what we could account for during the year, that we know the opening balances, we could account for the benefits paid out during the year, that is we could reduce the asset from the benefit paid out through, we use this as a fund, we reduce our liability, the interest expense have increased our liability and is a debit to P&L. The service cost, the current service cost or past service cost is a debit to P&L and credited to liability. If we have paid any contribution to the fund, it increases our asset and the credit goes out to cash. The interest income for the year will be credited to P&L and will be again debiting the asset. And finally, we'll have total balances. So we'll have the total given to us by the actuary. So if you noticed, we could account for the items for the year, but there is still one amount which can go unnoticed, which is unrecognized actual gain and loss. So when we total the balance, so when we total the debit of the assets, this is a debit balance, reduce it with the benefit paid out, increase it with the contribution paid to the fund, increase it with interest income. When we did the total, it did not match with the total given by the actuary, that is fair value of planned assets given by the actuary at the end of the year. This is the fair value of plan asset given by the actuary by the end of the year. This is fair value of plan liability given by the actuary at the end of the year. So this will result in some gain or loss, that either if the asset increases by the end of the year, that means there is a gain to us. If the asset decreases than what we calculated, then there is a loss. If the liability increases as planned, as calculated by the actuary, then there is a loss to us. If the liability decreases according to our calculation, we expected the liability to be, the opening balance was this, it decreased with the benefit paid out, it increased with the interest expense, it increased with the current service cost or past service cost. And when we did the total of the liability, the fair value liability calculated by the actuary is lesser, then there is a gain. If it is more, then there is a loss. The net impact, the net gain or loss is presented as part of OCI. So this difference is presented as unrecognized actuarial gain or loss, presented in this area is presented as part of other comprehensive income. So this is something which we could not account for. So if we could not account for it, we cannot blame the management for a sudden rise in gain, a sudden loss or a gain. We cannot give them credit for the gains. So this is presented as other comprehensive income. We'll present it as part of OCI. So this is second item, which since it could not be recorded, it could not be recognized throughout the year, this was calculated by the end of the year, this is unpredictable, is the reason this unrealized gain or loss is known as unrecognized actual gain or loss is presented as part of OCI, and this is also never reclassified to P&L. Hope it makes sense why these two items are never reclassified to P&L. The third item is a financial instrument which is designated at fair value through OCI. Financial asset which is an equity instrument. So third item is equity instrument designated at fair value through OCI. So among the Ind AS 109 is the standard applicable for financial instruments, which divides the financial assets into two parts. One is debt instruments and one equity instruments. The equity instruments are never measured at amortized cost. They are normally measured at fair value through P&L. There is an option to designate equity instruments which the entity intends to hold for a long period of time. This also saves unnecessary volatility in P&L every year, since according to Ind AS or IFRS, if an item is measured at fair value through P&L, it is required to be remeasured on each reporting date and the difference taken to P&L. So if you are recording an equity instrument, we'll be required to measure it at fair value through P&L. That's the way it is measured. And if you measure it at fair value through P&L, we need to remeasure it on each reporting date, and the difference is taken to P&L every year, which brings in volatility. But if our intention is to hold it for a longer period of time, which may happen if the entity buys an investment in a supplier. So the purpose of making this investment was not to gain out of the investment, but the purpose was to have an influence on the supplier so that they continue to supply goods to us, so that we continue to thrive in our own setup which we are making, in which we need the support of the supplier. So we may have invested this for having an influence on the supplier. So our intention was not to gain out of this investment, and since the intention is not to gain out of this investment, this difference being taken to P&L is causing unnecessary volatility. So we can designate, now there is an irrevocable option available. There is an option, there is an irrevocable option to designate equity instruments which the entity intends to hold at a long period of time, There is an irrevocable option to designate equity instrument which the entity intends to hold for a long period of time to measure at fair value through OCI. So the impact of this will be, since they are being measured at fair value through OCI, they don't have any chance to be reclassified to P&L. They are never reclassified to P&L now. Any difference on settlement also? On settlement they are reclassified directly to equity. Now they lose their chance of being routed through P&L. So if this irrevocable option of designating equity instruments to be measured at fair value through OCI is taken, then we have no option other than continuing to recognize it at fair value through OCI, taking the difference through OCI. On settlement also they are reclassified directly to equity. They are never routed through P&L. This is the third item which is under OCI, which is never reclassified to P&L. So we have covered the items which can never be reclassified to P&L. Now we look at the items which can be reclassified to P&L. So the items which can be reclassified to P&L, items which can be reclassified to P&L. Among them we'll pick the first item, which is, we just talked about, Ind AS 109 is divided into financial assets and equity instruments. So Ind AS 109 financial assets is divided into three parts. Debt instruments are also divided into three parts. The one which are contractually agreed cash flows, the business model is to receive contractually agreed cash flows and they meet the SPPI test, which is solely payments of principal and interest. They intend to receive solely payments of contractually agreed cash flows and they intend to receive principal and interest and intend to hold till maturity. And intend to hold till maturity. If the intention is to hold till maturity, they are measured at amortized cost. But if they are contractually in cash flows and solely payment of principal interest, but the entity may solely payment of principal interest and the entity may sell it. The third category is they are held for trading. Now if they are held for trading, they should be measured at fair value through P&L. Fair value through P&L. It makes sense also that since the intention is to hold them for trading, they should be remeasured each year and the difference should be taken to P&L. But if the intention is to hold till maturity, it doesn't make sense to remeasure them at fair value. So it's better to recognize them at amortized cost. But what about the situation wherein we intend to receive contractually agreed cash flows and solely payments of principal interest, but at the same time the entity may sell it as well. Now this is a situation which is somewhere in the middle. This is not clear. They are not clarifying whether they are holding it for sale. They are not clarifying whether they will be holding it till maturity. They are saying that if needed, if they need funds, they may sell it. So this is mandatorily required to be measured at fair value through OCI. So the standard on Ind AS mandates that if the business model of an entity is such that they enter into contractual cash flow agreements, they receive solely payment of principal interest, and on need basis, or if their business model in the past they've been doing so that they've been selling whenever required, they were not holding it till maturity. That means there is an element of uncertainty in it which should be recorded, which should be presented to the users of financial statements. So this element of uncertainty is presented to the financial statements through recognizing it through OCI. We cannot outrightly say that this is a realized gain or loss. If we could have outrightly said so that this is a realized gain or loss, we could have taken it to P&L. But we are not very sure about it. We are not very confident of recognizing it at amortized cost. We are not very certain to route it through P&L. So we use the medium available for unrealized gains and losses, that is fair value through OCI. So Ind AS 109 also mandates that we have to mandatorily recognize it at fair value through OCI. We have no choice. But one relaxation they have given is that on settlement, this can be reclassified to profit or loss. The resulting gain or loss, if we are settling is the resulting gain or loss can be routed through P&L. So this is the reason this is an item which can be reclassified to P&L. So we did not say that this can never be reclassified to P&L. This can be reclassified to P&L. So in settlement, this area which is measured at fair value through OCI can be reclassified to P&L. So we are able to recollect now. So we divided the OCI into two components. One, the items which can never be reclassified to P&L. The items which can be reclassified to P&L. In the items which can never be reclassified to P&L, we discussed about revaluation surplus, unrecognized actual gain and loss, and equity instrument, which was irrevocably designated. Irrevocable means if we have decided to move to this designation, will never be allowed to come back. Now in the items which can be reclassified to P&L, the debt instrument is not classified at fair value through OCI by choice. It is mandatorily required by the accounting standard Ind AS 109 financial instruments that if this is the business model of the entity, they need to mandatorily recognize it at fair value through OCI, and on settlement this can be reclassified to P&L. On settlement this can be reclassified to P&L. So this is another item of OCI. The fifth item of OCI is foreign currency translation reserve. Foreign currency translation reserve, also known as FCTR. So when we are dealing with foreign currency translation reserve, this is covered under Ind AS 21, the effects of changes in foreign exchange rates, the effects of changes in foreign exchange rates. So when we deal with foreign currency items, there are two stages to it. One is determining the functional currency. Now determining the functional currency is not an accounting policy choice. It is dependent on the primary and secondary indicators, which are like the currency which influences the selling prices, the currency in which we are incurring all our cost, the currency in which the entity is financed, the currency in which the entity retains or remits the funds to the parent. All these factors help us in determining the functional currency. Once the functional currency is decided, any currency other than functional currency is considered foreign currency. Functional currency is decided, any currency other than this functional currency, in spite of being in India. Our functional currency can be dollars, can be pounds, can be Swiss franc, can be any other currency. In India, 99% of the entities have functional currency as INR, but still there is 1% which is having a different functional currency other than INR. So if there is any foreign currency, that foreign currency is converted into functional currency and we prepare the financial statements in functional currency. This is the currency in which we are accounting or preparing financials. So when we are converting a foreign currency into functional currency, the conversion of an item may result in exchange differences which are taken to profit or loss account. The conversion of an item may result in exchange differences which are taken to profit or loss account. So once we have all the financials prepared in functional currency, there may be a situation that the presentation currency is different. Presentation currency is different. Presentation currency is the legal or statutory requirement to present in INR. Suppose our functional currency is dollar. We prepared our financial statements into dollar, and for meeting the regulatory requirements we have to present the financials into INR. Now the financials are prepared in dollars, the management's intentions, everything is clear, the activities are defined. Now simply the financials are being converted into a different presentation currency. Now if it runs into loss when we convert it, will we blame the management for it? The management prepared the financials into dollars, they were profitable, and now because of converting it into presentation currency INR, if the entity runs into losses because of the exchange fluctuation, can we blame the management for this loss borne by them? And if it gains out of it, can we give credit to the management that thank God you exist and because of you we are profitable today? So we can be loss making or profitable in dollars, and suddenly we may be loss making or profitable in a different presentation currency. So the management will definitely like to present in the currency in which they are very profitable. So to curb this, I think this is considered unrealized gain or loss, and this is known as translation. If you notice, I used the word conversion of an item. Here it is translation of financial statements. So there is a difference between conversion of an item and translation of financial statement. Here we are converting the entire prepared financial statements, which is balance sheet, P&L, cash flow statement, changes in equity. We'll be converting the financials into a different presentation currency, which is INR. So when we are translating the financial differences, when we are translating the financial statements, assets and liabilities are converted at the closing rate. Equity, income and expenses are converted at the average rate. So this is bound to create a difference, either on the debit side of the balance sheet or either on the credit side of the balance sheet. So the translation differences are presented as part of other comprehensive income Translation differences are presented as part of other comprehensive income known as foreign currency translation reserve. Known as foreign currency translation reserve, that is FCTR. Now this is presented through OCI. This comes under the purview of items which can be reclassified to P&L. So when it gets a chance to get reclassified to P&L, the management, this is a foreign operation which we are consolidating or we are translating for the purpose of consolidation. So we present it into a different currency. Now on disposal of this foreign operation, on disposal of the foreign operation, the FCTR gets realized and it can be reclassified to P&L. Now by deciding to sell this foreign operation is a decision taken by the management So they should be given credit for any gain and they should be blamed for any losses because of this decision. And if there is any FCTR relating to it, that gets realized on disposal of the foreign operation, and on settlement this can be reclassified to P&L. This is another item which is on translation of financial statement is present as part of OCI, but on disposal of the foreign operation can be reclassified to P&L. Then there is another item, cash flow hedge. Now, hedge accounting is voluntary. This is covered under Ind AS 109. Financial instruments are not covered. Any exchange differences because of hedge accounting are not covered under Ind AS 21, the effects of change in foreign exchange rates. If you notice, there was a standard specially for it. But if you are dealing with hedge accounting, it is covered by the standard Ind AS 109 financial instruments. Ind AS 109 will take care of the movement in hedge accounting. Now in case of fair value hedge, the difference is taken to P&L, but in case of a cash flow hedge, the effective portion of cash flow hedge, is presented as part of OCI, that is other comprehensive income. The ineffective portion is presented as part of profit or loss account. The ineffective portion is presented as part of profit or loss account. Now what is ineffective? Now there used to be a relationship in the range of 80% to 125%, which has been taken away now. The effective portion is considered. Now hedging means that there is a hedged item and there is a hedging instrument which we choose. Now this hedging instrument is chosen that it will set off any loss on the hedged item through a gain on the hedging instrument, or if there is a gain on the hedged item, it will result into a loss on the hedging instrument. If it meets this quality and there is a hedging relationship between them, then only we do hedge accounting. So the intention is not to gain out of it, the intention is to minimize the exposure to risk. The intention is not to gain, the intention is to minimize the exposure of risk. So if the intention is to minimize the exposure of risk, so any change in the value of hedged item and value of hedging instrument, we would like that up to the value of hedged item, the change in fair value of instrument, up to the value of hedged item, the change in fair value of instrument is effective. If it fares beyond it, the change beyond it is considered ineffective. So if it is going beyond it, our intention was that if it settles up to the value of hedged item, we are happy with it, we do not wish to gain out of it. But if it goes beyond it, that is considered ineffective. So the effective portion is taken to OCI, the ineffective portion is presented as part of P&L. And in future, on settlement of cash flow hedge, if it impacts profit or loss, it can be reclassified to P&L. Why I say impacts P&L? Because it may result into an asset or a liability, so may not impact P&L. But if it impacts P&L by any chance, then it can be reclassified to P&L. So this was another item which could be reclassified to P&L. So if we sum up, we divided the items of OCI into the items which can never be reclassified to P&L and the items which can be reclassified to P&L. So if I summarize it, the items of other comprehensive income, I hope they are clear with you now that why the concept of OCI exists, and if it exists, what all is included as part of OCI, and the items in OCI also covers the complex standards of Ind AS. So indirectly, by understanding OCI, we are also becoming well versed in the complex standards of Ind AS automatically if you understand OCI. And if you understand this concept, you also understand some of the key important topics of Ind AS, which is covering financial instruments, hedge accountings. Mainly it is covering financial instruments, the revaluation surplus model, the effects of change in foreign exchange rates. So if we summarize, in other comprehensive income, the other comprehensive income is divided into two parts. The other comprehensive income, items which can be reclassified to P&L. Items which can be reclassified to P&L, they are which can never be reclassified to P&L. They are revaluation surplus, unrecognized actual gain or loss, unrecognized actual gain or loss. Third is equity instruments designated at fair value through OCI. Then there are items which can be reclassified to P&L. Items which can be reclassified to P&L, they are foreign currency translation reserve, translation reserve, then there are debt instruments, mandatorily designated at fair value through OCI, and the effective portion of a cash flow hedge. So this is how we deal with other comprehensive income. If you have any doubt, you can get back to me. You can follow me on Unacademy with the name ACCA Amit Kumar, and the code to be used to avail discounts on Unacademy is ACCA Amit. So this is regarding the insight on other comprehensive income. Hope you enjoyed the lecture, and do share it with your friends as well so that they can also gain insights on the concepts of OCI. If I share a brief about me, I've been training on IFRS and Ind AS. Being a member of ACCA UK, I got an opportunity to train chartered accountants in the country since 2009, and I've been training finance and accounting professionals on the subject of IFRS and Ind AS since then, and have worked with the key companies who are working on IFRS. So it was the first training company, Parent Corporation. Then I studied the first ACCA Institute at Delhi. Later I joined KPMG. I was one of the lead trainers at KPMG during the peak season of IFRS, that was in the period 2014 to 16. So I was leading the IFRS trainings at Delhi as well as Mumbai, was one of the lead trainers on the subject of IFRS. Joined TMF Group for a brief period and authored a book on Ind AS known as Ind AS Concepts in One Day, because I was feeling I could help CA final students to gain insights on Ind AS since it was changing in India, and I've been learning it since 10 years now. Till recently, I was director with Accounting Advisory Services BDO India, and was also head Learning Solutions Pan India for IFRS trainings, not only training the teams within BDO as well as offering the services outside as well. Currently, I am founder and CEO of Prometia Business School, offering ACCA qualification after 10th, 12th for graduates, supporting chartered accountants to train them on the subject of diploma in IFRS, which they appear from ACCA UK. So this is all about me, and subscribe to the courses on Unacademy which are offered by me every month for CA final Ind AS subject. I've been offering them at various times, so you can gain insights not only through the technical knowledge but also through the practical exposure gained over years. Also, I need to add on that Unacademy is beginning this course on 28th of December. We are coming up with an exclusive live batch which is known as warm-up session. So the warm-up session is being presided over by CA CS Anshul Agarwal, CA Arina Rais, CA CS Shrey Rathi, and CA Vikram Biani. So they are the top educators of Unacademy, offering their services for CA inter aspirants who are willing to succeed in their first attempt. They can join these warm-up sessions, and they all are coming together exclusively for you beginning this 28th of December. So do not forget to subscribe them and take advantage of their services through live interactive classes. Learn from the top educators who will share their insights through their work experience gained over the last many years. So they'll be able to share the insights through these warm-up sessions, and it's an opportunity to learn from all the educators together who will be enhancing your knowledge so that you become successful in your November 2021 attempt. So there will be dedicated doubt clearing sessions, weekly quizzes, and concept testing, one subscription, all educators, all students. That's the USP of Unacademy, that and it's an opportunity, like it's a huge opportunity for anyone who is learning on Unacademy, that they get to have access to the lectures of all the top educators who have learned or have been serving the industry by training or by working practically in the corporate world and have insights. So this is a great opportunity to learn from all the top educators at one platform. So do subscribe to this course. So this is a request for the CA inter aspirants who by chance happen to see this program, who are also simultaneously preparing for their CA final courses, and if they happen to see this session, so this is for you, that you can also gain from this warm-up session beginning 28th of December. So do not forget to subscribe, and do not forget to follow me on Unacademy. Hope you enjoyed the insights on other comprehensive income, and we'll be able to bifurcate the difference between realized gains and unrealized gains, and what this concept of OCI meant. So though it was being read by us many times, but the real insight of how it is comprehended and how it is to be used in reality, I hope this is clear. Thanks for your valuable time. All the best wishes for your examinations. We all are here to support you for your success, and your success is our success. Thank you. So this is all for the day. All the best wishes.